Hi everyone. Welcome to Bright MLS's Housing Market Update webinar. My name is Erica Plemmons. I'm a senior economist at Bright MLS. Lisa couldn't be with us today. She had a few conflicts, but hopefully she'll be with us next webinar. In the meantime, I'm happy to run you through what the latest economic and housing data trends are telling us. We're going to start with the economic landscape. The economy and that backdrop helps us better understand how businesses and consumers, whether that's buyers or sellers, are feeling. And we know currently there's been kind of a hesitation because of the economic uncertainty. The labor market in particular showed mixed signals in its latest release. The top chart represents the monthly change in the total US employment. So because all the bars are above that zeros line, that means there has been steady monthly gains in the employment picture. Now, this is showing a resiliency in the economy. Particularly in May 2023, there were 339,000 jobs added, and economists were expecting maybe more in line with 190,000. So the fact that this beat expectations showed that job openings looked better than kind of anticipated. On the other hand, we can note that the job gains in this past month weren't as robust as what we saw in 2021 and some of 2022. So there has been a softening. But the other employment data that came in was the US employment rate. And while an uptick was expected, we've seen the headlines with layoffs, particularly in the tech sector. The fact that the unemployment rate bumped up from 3.4% to now 3.7% was a bit of a surprise. So this is showing more of that weakness, more of that economic cooling. The other thing in the BLS report that was highlighted is the fact that people may be taking longer to rejoin the labor market. The category of those unemployed for 15 to 26 weeks, that in particular saw a bump up in its numbers in the latest release. So while people have been finding jobs, it is taking a longer time. The labor market more locally, thinking in the Mid-Atlantic, some of our major cities, is showing that it's similar, if not better, than the US overall. In Philadelphia, Baltimore, and Washington, D.C., you can see the unemployment rate is a bit lower, and it continues to show that this area in particular has a good labor market, which should therefore support the housing market. One of the big releases this week was the inflation data. The Consumer Price Index, or CPI, shows the basket of goods a typical consumer would expect to spend and how that has changed over time. So inflation has been dropping. It's fallen and reached its lowest level since April of 2021. But on the other hand, it's still particularly high. Compared to last month, it was up just 0.1%. But compared to the previous May, inflation is still up 4% year over year. And that's double the Federal Reserve's target inflation of 2%. And their target is representing what they think a healthy amount of inflation would be in a growing economy. So the overall CPI is that blue line, and we can see it's significantly down from its peak, which is a good sign, but still we've got a ways to go to that 2% level. On the other hand, the shelter component of the CPI, represented by the green line, it has just come off of its peak. So because of that, we are expecting that the shelter component, which is a lagging component of the index, will continue declining in the coming months and put downward pressure on the overall CPI number as well. And with these economic thoughts in mind, we turn to what the Fed decided yesterday. The Federal Reserve paused their rate hikes. The Fed has been trying to combat inflation, and there have been 10 consecutive hikes in a row. And we know that when the Fed increases that short-term interest rate, that has impacts on the 30-year fixed mortgage. The 30-year fixed mortgage rate is influenced by other factors such as demand for the US Treasuries, but you can see that correlation between these two lines. The one thing that did come out of this meeting, though, is that even though there's currently a pause, within the rest of the year, they're projecting they could need maybe 2 more increases in order to fight against that inflation that is higher than they want it to be. Many people are thinking that, the Fed is pausing so it can collect more data next month before its meeting in June to determine whether they're going to resume rate hikes or continue this pause. So while we're waiting on the Fed, we're going to see what the mortgage rates do for the next couple weeks. The mortgage rates could stabilize or possibly even fall a little bit. One of the things interesting about the mortgage rates is that for historical trends, there's a general gap between the mortgage rates and the 10-year US Treasury. And that gap has been wider than normal. And that indicates some of the economic uncertainty. So if that gap could start to close, we could see mortgage rates fall, even though the Fed is maintaining their rate levels. If you are interested in all this economic insights, I'd encourage you to follow Bright MLS on LinkedIn and on Instagram. Our chief economist, Dr. Lisa Sturdivant, she provides commentary on all of these economic releases. And as you know, the economic data are going to impact consumers and your business. So to stay on top of it, I'd recommend you follow along. Now, getting back to our mortgage rate story, what are we seeing? Mortgage rates have consistently changed over time. Between the 1990s and 2000, the average was around 8.1%. And then we get into the 2000 to 2010 period and it drops a little bit and the average is 6.3%. And it drops even further between 2010 and February of 2020, averaging about 4.1%. And of course, everyone's familiar with what happened when the pandemic started. Rates dropped and they were around 3%, and they stayed in that territory between March 2020 and March of 2022. And so, of course, these low rates, this lower borrowing cost, meant that there was a spur of demand for home ownership. Now, rates are 6.5% on average, and that resembles what has typically happened over the long term. But for a buyer today, seeing rates at this level compared to 3% before really impacts their bottom line. If we consider mortgage rates and a few home prices, we can see what happens. We'll start with that orange section. So if a buyer is purchasing a $300,000 home, if interest rates have moved from 3% up to maybe even just 6%, that is roughly a $500 difference in the payment they'll make each month. And so for buyers today, they have to prepare, is their budget able to stretch that far? Even between like that 6 and 7% rate, think of a median buyer. So for instance, I pulled out the Baltimore's median income from the census. It's $86,000. So at a 6% interest rate, maybe they are comfortable being able to afford a home that's priced around $300,000. But if rates are nearing 7%, that's pushing the boundaries. And so with buyers on a tight budget, you're going to see there's plenty of obstacles they're facing, not only with the interest rate, but the homes that are going to be available on the market today. If we push that budget up to $500,000, we can see that there's a big difference between the payment on those two types of homes. For a buyer purchasing at a 6.5% rate, it's $1,323 difference per month on those two types of homes. So even though that's a large jump in price change, even smaller incremental jumps in the difference of homes can add a significant amount to their monthly budget that would need to go towards housing. And one of the reasons why I want to bring up these prices is because last subscriber webinar, one of the participants had asked, well, are these trends true across prices? So as we dive into the particular market statistics this webinar, I want to show some breakdowns by price so you can understand whether the trends hold true for your specific buyers and sellers. So starting with a big picture, closed sales rebounded from their April dip. From April to May, closed sales jumped up 21.2%. And this was a very welcome sign. April's dip was a bit surprising. In the Mid-Atlantic, what tends to happen is it's spring home buying season. Closed sales make gains month over month. But in April of 2023, closed sales were lower than what they were in March of 2023, which was a bit surprising. But seeing this rebound makes us have continued faith that even though 2020 seasonality is not going to be the same as past years, there is still that strong home buying interest in spite of what people are facing in today's market with higher prices and higher interest rates. Now, are closed sales down across the board no matter the price? Let's take a look at 3 periods of time. First, we'll start with May 2019, then move to May 2021, and finally end with our latest month of May 2023. If we break closed sales data down by price categories, what we see is that for the most part, there was a peak in May of 2021. Well, why? Interest rates were that lovely 3%. So there were more people encouraged to buy, and they stepped in the market and they contributed to higher closed sales. On the other hand, if you focus on the orange line, the bright orange representing under $300,000 price homes, you see this steady decline in fewer closed sales through those time periods. Now, one of the reasons why we're seeing this decline is because a home that was maybe $250,000 in May 2019, it's likely not going to be priced that way today. So part of it is with price appreciation, fewer homes fall into that bucket. Now, I also want to focus on just the 2 time periods. May 2019, when we are considering, 2019 a benchmark year, a good typical real estate market activity time for the Mid-Atlantic compared to today. And this shows a clear picture. You see the steep drop off for the under $300,000 homes. And if we look at the difference, those priced under $300,000, those closed sales are practically cut in half. We also see a modest drop for homes priced from $300,000 to $500,000. And remember, we have homes moving into that category that had previously been priced lower, but also homes moving higher than those prices with their price appreciation. So the fact that this is dropping somewhat shows that there's some tightness for homes that are lower or moderately priced. But for homes priced $500,000 or above, for all of these different categories, there have been gains in closed sales when we compare it to a typical real estate time. Now, part of the difference in closed sales is, of course, our interest rate picture. There's less demand today than there was a year ago. But the other part of the picture is the fact that buyers really don't have much to choose from. Inventory throughout the United States and in the Mid-Atlantic in particular is very depleted. If you looked at the latter half of 2022 and into 2023, inventory was starting to grow. There were gains in active listings, which was an encouraging sign. But if you look at the orange line representing 2023, what's happening in May is it almost seems to merge into the gold line representing 2022. So although it's 1.5% higher than last May, it's very close, and those gains that we were getting in inventory aren't happening any longer. but our inventory gains the same across prices. You probably guessed it, with like closed sales, all inventory is not equal. Let's first picture if we were in January 2019 and there were 100 homes available for a buyer. 53 of those homes would be priced under $300,000. Now, in May 2023, if we had those same 100 homes, they're on the market, 30 of them would be priced under $300,000. And again, this goes back to partially price appreciation and also just the difference in the composition of homes being placed on the market by sellers. But that's not really a good comparison. We know inventory overall is lower than it was in January of 2019. So the 100 homes that were available then, there's not 100 homes available today. Looking at the raw counts, you can see the difference in our inventory picture based on price. With homes priced under $300,000, what was available in January of 2019, there's only about a quarter of that available for buyers today searching in that price category. Nearly all price categories show a decline in inventory, with the exception of the $1 million plus category. If we had looked last month, it would have shown a slight decline, but in May, it is actually up just a little bit, and I would actually call it relatively flat. So in general, for any buyer now versus a more typical time, they're going to have fewer homes to choose from than they would in the past. Now, that picture doesn't look likely to change. New listings are at a 2-decade low. So we can see that orange line. It is significantly below what happened last year, the gold line representing 2022, and also the more typical years in the blue when housing was running fairly smoothly, 2018 and 2019. And although I'm not going to show it here, I'll let you know that for new listings, the ones that are being added to the market tend to fall in those more moderate or higher price categories, especially compared to the new listings that were entering the market in 2019. So with the listings of different prices and the closed sales of different prices entering and leaving the market, what has happened to home prices? Have they peaked? In May of 2023, the median home price in the Mid-Atlantic was $400,000. This was up just 0.3% compared to last year. But remember, last month in April, we saw kind of the reverse trend where the median price was just slightly below what it was in April of 2022. So home prices overall look relatively flat. And this is a big picture. Now, we want to dive deeper to understand more local trends. But with the overall Mid-Atlantic, what we can tell by this flatness is the market is still churning and there's still that demand that is holding prices high, especially with the low inventory, compared to, we know some areas of the country, such as California, are already reporting price declines. When we look at 3 of the major metros, are Baltimore, Philadelphia, and Washington, D.C., we see differences in the trends. For Baltimore, the median price has been flat for the past 2 months. And for Philadelphia, it has actually been continually rising. The median price has been increasing month over month over month and continues growing. On the other hand, we have Washington, D.C., where this metro area has shown year-over-year price declines in 4 out of the 5 months in 2023, though those price declines have even been modest and could be due to the mix of homes selling at this time compared to last year. Now, you may wonder, well, what about my area? Maybe I'm not working particularly in these 3 metros. Well, the Mid-Atlantic overall is seeing either flat or increasing median prices in the metro areas the Bright MLS covers. If you are interested in your metro area, I'd encourage you to go to brightmls.com/research. Our May monthly market reports are available for all of the metro areas. And within those reports, you're going to see statistics like median price, closed sales, active listings, new listings, and more. And you're also going to see those breakdowns by county, as well as commentary about what your local trends mean and the differences between those submarkets of counties. While prices are seeming flat, do we think that that's what's going to happen ahead? Well, with our inventory picture, we know that things are tight and that should hold prices firm. But what about transactions? We can't predict the future. We don't have a crystal ball, but new pending sales are a great way to anticipate maybe what's coming in the next 30 to 60 days, as they tend to lead closed sales by that amount of time. And what we see is there's been slow and steady growth in pending sales through the past several months. So there is this continued demand despite higher interest rates and higher prices. If we think about the demographics of the United States, there's a large portion of the population that are in their early 30s. That's the prime first-time home buyer age. They are maybe forming households, having children. So there is going to be continued demand for housing. It's whether these buyers can afford to jump in or whether they need to sit on the sidelines. And even small changes in the interest rate, like we saw, can make a difference of $100 on your mortgage payment, and that could determine whether you could be in or be out. And for buyers who are in or buyers who plan on joining, it's important to understand that because of the low inventory picture, demand is very fierce. The competition makes the market tight. And as of the May 2023 statistics, what we see is that half of the homes that closed in May were off the market in a week or less. So while closing may take longer time to happen, basically homes that entered the market were then off the market and not available as a choice for buyers within 7 days or fewer. Half of the homes that sold, that was true for. Now, obviously, there are homes at the other end of the spectrum that have been on the market for multiple months. And that's why it's important for agents and brokers to properly educate their buyers and sellers so they get a true picture of what's going on in their individual market and how to price their home to either sell or provide an offer that's going to get the home that the buyer desires. When we think about what's coming this summer and later in 2023, what are our expectations? Now, before I dive into what, Lisa and I have discussed and what, generally economists and analysts are expecting of the housing market, I want to defer to you. So Bright MLS has been sending a subscriber survey to agents who've completed a transaction in the previous month. And this has been a great way for the research team to dive into data that is not available in the MLS. So I'd encourage you, if you receive one of these surveys, to please fill it out because it gives us vital information about changes in the market and about the differences between buyers, whether they're first time or repeat. And we can then deliver that data to you. We're working on the results of our June survey and it will be published next week. But in the meantime, here's a sneak peek of how the outlook of what you think for buyers and sellers has changed since April. So in April, buyer activity, according to agents and brokers, was expected to be high to very high. Nearly half of agents thought so. But now that we're in June, only 41% of agents and brokers are expecting buyer activity to still fall into that high to very high category. Now, that doesn't mean buyer activity is going to be low, but it just means that there's less optimism about, what buyers can afford. If you looked at interest rates from April to June, what we see is there's been a pretty steady upward trend, or at least it's been generally upward. So for buyers who are kind of that edge case, they may not be able to join like they would have want to, hence lower expectations for these upcoming months. When we look at seller activity, the expectations are pretty evident. We expect low, or agents and brokers expect low to very low seller activity. If you're a seller who's locked in a 3% interest rate or refinance down that low, and your home suits your needs, it's unlikely that you're going to be motivated to move. And the agents and brokers that think that the activity is going to be low to very low has increased since April. In April, it was 51%, and now it is 60%. So how can you take this information and distill it for your buyers, your sellers, and talking with colleagues? For buyers, there's many things that you can tell them about the market, but the one thing I would hone in on is the fact that inventory is so low. If your buyer is looking for a home price under $300,000, even under $500,000, the amount of inventory available is very depleted. And if they do find something that is appealing to them, they need to act quickly. If you're working with a seller, while agents and brokers may not be as optimistic about buyers as they were a few months ago, there's still continued demand for homes. And if the home is priced properly, it will be selling quickly, so they need to prepare for that. When you're talking to agents, brokers, clients, what should you do as an agent or broker? Well, you need to give a true market picture. It's important to distill whether things are fact or whether they're fabricated. You're going to see a lot of headlines about the housing market. It's a very hot topic. Things are changing, but it's important to dive deeper and look at data and what is going on the ground to understand what is true and what may be just, emphasized to get readership. So with that in mind, one of the resources, of course, I'm going to direct you to is brightmls.com/research. We not only have those monthly reports I mentioned earlier, but there are weekly reports for the different metro areas and the Mid-Atlantic overall. We write frequently, and we have that in our news and insight section, where you can see special interest topics, discussions about migration and demographics and more. We would love for you to join us on our next housing market update webinar, which is scheduled for Thursday, July 20th. And please, if you do get one of those surveys, answer it. It literally takes less than 5 minutes of your time, probably only 2 or 3, and it will help us get more data to share with you about your market picture. If you need any information from us, you can contact our team. Our chief economist is Dr. Lisa Sturdivant. I am Erica Plemmons, and we also have a research analyst, Colby Stout. Our slides, as well as the recording of this webinar, will be available on the Bright MLS website under the News and Insight section. And I'll double check to see if this is also being sent out to those in attendance. You can also find the recording of this on the Bright MLS YouTube. So thank you very much for joining me today. And if there are any quick questions I can answer, I'm happy to, or please get in contact with our research team.
Hi, Erica, Donna here.
Hey, Donna.
We did have a request for a show a slide again. I believe they said it was like maybe slide 16 or 17. I don't know.
I'll go backwards.
The graph.
Let's go here.
Yeah, I think this was it. Is that correct there? Hang on. Kendra, can you let us know?
And if this wasn't the slide, like I mentioned, we will have the presentation available on the Bright MLS website. So you can use any slide if you want to, share it with your clients or post it in a blog or social media. Feel free to use it as you see fit.
We do have, do they get a recording of this, or do they need to go to the website for that?
That's what I was gonna defer to you if, if we.
Usually if you sign up for a webinar, you do get a recorded version. So
Okay.
look out for that. If it's the same as all the other webinars, yes, you will get a recorded version, Kim. And let's see, Valerie, what are the statistics we should be tracking on a weekly basis to provide to our clients, perhaps via social media?
Yeah, so Bright MLS puts together weekly reports, and the current focus of those reports is on new listings. We also track the list price as well as showing activity, because that tends to be a leading indicator of demand. Those are available on brightmls.com. I don't know that they're currently packaged for social media, the reports themselves, but our Bright MLS social team does tend to post them when we release them each, I guess, does it happen I guess the release is Tuesday, we work on it on Monday. So you should be seeing those in your social media feeds, whether it's LinkedIn, Instagram, Twitter. They tend to post them, and then the reports themselves are available on the website.
Great. And that was the correct slide. One more,
Great.
we have a question from Richard. Do you have any insights with new construction?
Yeah, so unfortunately, I haven't dug into the Bright MLS data in particular about new construction, but I have been reading a lot about it. And particularly last month, I had mentioned there was a survey from John Burns Real Estate Consulting, where there's a lot of optimism now on the new build side because inventory on the existing side is so low. So while builders had previously expected not as many new home sales and construction this year as last year, now they've kind of reversed their thinking because of the inventory picture and the fact that new homes are tending to make a more significant portion of the sales. And according to, I think it was the National Association of Home Builders, they had estimated that in the past, home sales, about 10 to 15%, I think, were typically new homes of all home sales. And now that figure is around 30%. So there's a lot of reliance on that new home category in the market activity.
Super. Okay. I don't see any other questions. And thank you, Erica, for doing a great job filling in for Dr. Lisa.
I appreciate it. And thank you all for attending, and we hope to see you next month.
Sounds good. Thank you, guys. Bye-bye. Great job. You had a compliment in the chat.
Good.